Hello and welcome, I'm Sayash Maheshwari and you are watching Last Tick here on News9 where we break down the day's action on the last trade. Now, Indian markets ended Friday's choppy trade in the green, but for the week ended marginally lower and today the market opened on a flattish note but turned extremely volatile in the opening trade itself, with Nifty moving in a broad range of about 150 points in the first couple of hours of trade. However, after making a low of 21,630, and we'll talk about the importance of this level in just a bit, the markets finally found some direction and moved higher from there on to ultimately settle in the green. At close, Nifty, as you can see on your screen, was up 0.3% and ended at 21,782 mark. The low of the day, as I mentioned, came around the 21,630 mark, which by the way coincides with the 50% retracement level from the Jan low of 21,137 to the most recent record high of 22,126 mark. Meanwhile, the index faced resistance at 21,800 mark, and it ultimately settled lower than that, just about 18 points shy of 21,800. But for the week, Nifty has ended with a cut of 0.3%, and if you look back at the last 4 weeks, 3 out of those 4 weeks the index has ended in the red. But I think the good thing is that the base overall is shifting upwards, which perhaps certainly suggests that the medium term texture of the market is still bullish. Meanwhile, in the near term, it's a tussle between the bulls and the bears out there. But moving on, Sensex ended with gains of about 167 points to close just shy of the 71,600 mark. For the week, the 30 share index is down 0.68%. The broader markets now, they witnessed some profit booking today, with both mid-cap and the small-cap indices ending with cuts of about 0.8 to 1.4%. And for the week, for the entire week, the mid-cap index ended with gains of about 0.85%, whereas the small-cap index ended flat with a negative bias. It was down about 0.05% for the week. But moving on to the sectors, it was the banking pack that led the charge today. And remember, the index has been a major drag on the markets. In fact, it was one of the primary reasons why we saw the sort of correction, 1% or more correction we saw yesterday. But today, Nifty Bank led from the front, rallying about 1.4%, and both PSU as well as the private sector banks contributed to the upside. In fact, if you look at the overall gains of Nifty, 45% of all those gains came from just 3 stocks, and those were ICICI Bank, SBI and Axis Bank. Among other sectors, Pharma and FMCG names also contributed to the upside, while metals, IT and auto indices capped the gains. But with that, let's also bring on board Mr. Mohit Gang, CEO of Moneyfront. Mohit, Nifty has been trading in this range of about 21,500 to 22,100 for the past few sessions and all. I mean, if there is a breakout, in what direction would it be? And if you could help us understand what sort of a percentage upside or a downside can we see after this breakout?
Hi Suyash, always a pleasure to be speaking with you. So I understand that Nifty is not giving a breakout either ways. It is not correcting much, and neither is it like really breaking out of this range. But one thing which comforts me is that the lows are higher lows. So Nifty isn't like really breaking the previous lows consistently, and which to my mind just kind of suggests that the trend remains intact. Honestly, even if I look at the larger macro scenario, though people might argue that the RBI policy action wasn't dovish enough, they weren't like really clear about when the interest rate cycle will start reversing and when they would come out with rate cuts, and perhaps also the liquidity condition in the banking system is very tight right now. But having said which, I think the policy stance which is maintaining the rates at status quo is a good enough stance for the markets. Markets though were anticipating it, but I think it gives even more impetus that the rate hikes are not there in vicinity. And so is the case with US Fed also. I think similar kind of action has got reiterated in US itself, where the Fed is not very clear as to when they will start cutting the rates. But yes, they have maintained status quo. So my sense is, if you see the 10-year yields in US, though have inched up, but in India they have inched a little lesser. I think these conditions will continue to be a little more benign for equity markets unless there is some what do you say, an event which unfolds or something, some major news flow comes in and tumults the market. My sense is the momentum continues to be towards the upside.
All right, and certainly RBI Governor Mr. Shaktikanta Das did not really talk about when that next rate cut could come. What's your expectation, Mohit? Do we wait for Fed, for cues from the Fed to see when they are going to cut interest rates in US, or we diverge?
Look, it is very difficult for India as a country to diverge because that might have adverse impact on the currency and the trade balances for us. So I think it is difficult for a country like India to be cutting rates when US is not. My sense is I think the rate cut should ideally happen first in US and then India will follow suit in a practical scenario unless something otherwise happens overall on the macro front. Right. And yields are not a concern for Indian Central Bank because come June, you will see a lot of inflows on the Indian bond markets happening through JP Morgan bond inclusion and the Bloomberg bond inclusion. So yields
Right.
are not a matter of concern. Yields will continue to ease, and which gives RBI enough headroom to continue to pause the rates at these levels and not cut it further.
All right, and do you expect a pre-election rally, or do you think the market has already priced in the expected continuity in the regime?
Suresh, aren't we all expecting a pre-election rally? And that's already we are. I think we are in the midst of that, right? Honestly, I think the rally has never stopped to my mind. You can argue that for a week or 2 week the markets are pausing, taking a kind of a breather. But I think we should just be kind enough to allow markets to do that. Honestly, it's been a ferocious rally. Just to give some perspective, on 8th of December when MPC last was conducted, markets touched 21,000. And on 8th of Feb, we were almost hovering at 22,000 levels, right? So
Right.
in a quarter, 1,000 points on Nifty is not bad for the takers. So my sense is the momentum continues to remain intact. Yes, pre-election, people are anticipating some kind of correction. I won't deny that. You would see bouts of profit taking, which definitely is likely to happen in certain sectors, and which we have seen some signs of those in today's trade and perhaps in the week that people are picking out and taking some profits from the table and few particular pockets. So which would continue to happen, my senses.
But can we see 23,000 on Nifty, by April?
So I think ye dil mange more, right? And I think we all would want to see that level come soon. Sooner or later, it will definitely come. Whether it comes prior to election or post that, honestly, I think it is for the astrologers to predict that. I would still continue to remain bullish on India per se from a long-term perspective. And my sense is people would still make double-digit returns this year, even if not very high returns. I think double-digit returns are not very bad for someone who wants to be continue to investing in equities.
All right, and talking about momentum, of course, the market is being driven by momentum, and a lot of sectors are also performing because of it. But the BSE PSU index saw some profit taking today. It was down about 3% in the morning trade, recovered a little, but still ended about 1.7% lower. And even the railway stocks bled today. These stocks have, of course, delivered massive returns in the past 1 year or so. But from a valuation perspective, is there's a still valuation comfort here?
Look, Suresh, I won't advise anyone to enter into any of these railway stocks per se at these levels. Honestly, I think the run-up has been quite crazy. It defies gravity to some extent. Some stocks have gone up 10x in last 1 year, and sooner or later, as I said, a few pockets will see bouts of profit booking, which is what is happening out here. One can argue that the RVNL results were not very great, and it all started from there. But I honestly think that's one of the excuses. The stocks are fairly richly valued, right? And people will take profits from the table. To add to that, the budgetary allocation on railways and a few other infra-related sectors per se is not what do you say hugely encouraging, right? Markets were expecting huge numbers out there. It is a great number by all means, but it isn't like to the tune of what happened last year. So I think there is some disappointment on that count also, and perhaps that is what is weighing up on these some of these stocks. And my sense is we should not be surprised if we continue to see some continued pressure on these stocks for more profit taking.
All right, and of course, the reason why RVNL corrected as much as it did was because of a Q3 miss. But Mohit, coming to you, what's your assessment of the December quarter earnings? Any hits and misses in your opinion?
Look, honestly, I think some of the larger names have kind of given us some comfort. On an overall basis, I think it was a good quarter for the industry put together. If you see the larger private sector banks, the likes of ICICI Bank per se, I think the results were fantastic. Even SBI for that matter, I was fairly impressed with the results. It showed a decline in PAT, but the disclosures on the wage numbers and other things was fantastic, and I think it augurs very well for the stock going forward. On the IT pack also, I think they've kind of hit rock bottom last quarter itself. So from this quarter, we have seen some green shoots coming up, and my sense is coming quarters will give us greater impetus. I think the results were disappointing on the consumer durable staples and FMCG pack put together, which is
Right.
where I don't think so. We are still seeing shoots of rural demand pickup and so on and so forth. But otherwise, on the whole, I think the results are positive.
All right, and one particular segment that I wanted to get your view on was new age tech companies. They have had a phenomenal Q3. Delivery, PB Fintech, they turned profitable for the first time. Nykaa's profit doubled on a year-on-year basis. Zomato's quadrupled sequentially. I mean, in this new age tech space, anything that looks attractive to you, sir?
Suresh, look, honestly, we keep away from these stocks because to us, I think these are still very, very richly valued. Though I understand the story that they are coming, turning black now. Whatever profitability numbers are kicking in for most of these companies. Zomato per se, honestly, if you ask me, I think stands out in the pack because of the Blinkit story also. I
Right.
think it's a great tech play plus a great delivery play plus I think it's a great play overall. On the others, I'm not so keen, though I understand that the results are turning good for these and perhaps will keep turning on. But still, if you see on a valuation basis and compare them with other listed pack, I see a lot of gap out there, honestly, and I would still stay away from this pack.
All right, and Mohit, before we let you go, the markets have been extremely choppy. VIX is above 16. It is very close to the 52-week high. So, from here till elections, what would be your advice for retail investors, sir?
Look, every new pot of money has to be very carefully put into the market. Honestly, I think people should stagger from here on, not put in huge chunks in the market. Markets are very richly valued at the cost of repeating my own self here. But you cannot be out of the market, Suresh. You cannot be pulling out all the money, anticipating a correction. To my mind, that's worse for the portfolio. You have to stay in, face any correction if there is one likely at the corner. 5-10% correction I think should be taken into one's stride if you're investing for long term. But the cost of staying out can be much higher, perhaps. So my sense is just stay invested in the market. We can all be positively surprised with the upsides this market can provide, even during the course of elections and post that as well. So my sense is just stay invested.
And apart from equities, any other asset class that you would advise perhaps adding to the investors' portfolio?
Oh, Suresh, actually, this is one of those golden times when we are extremely, extremely bullish on both debt and gold, but more so on the long-term debt side, on the long end of the curve. I think the rates are likely to ease. There are all indications that rates will ease. The 10-year in India has already eased from 7.25, 7.3 odd levels to 7.08, 7.09 thereof. Right. And my sense is with the bond inclusion happening post June, the yields will further ease, and then RBI will come up with rate cuts perhaps during the fag end of this year or even maybe let's say next year. But with a 2-year call, if you are going long duration on debt, I think there is enough and more money to be made from the debt side also.
All right, debt instruments and gold looks attractive to Mohit gang at this point in time. Perhaps you can add that to your portfolios in the run up to elections. Sir, always great insights from you. Thank you for joining us here on News9.
My pleasure. Thanks.
Well, that's all we have in this segment of Last Stick. Stay tuned with us and keep watching News9.
हमारी नारी शक्ति को सशक्त करने से ही